This is an educational example based on my personal approach. Results vary widely, and nothing here guarantees profit or future performance. Hello, everybody, and welcome to the Trading with Ashley show. I have some exciting news to share with you. Most of you have watched several of my videos, and you've noticed one of my daughters in it. Her name's Landry, and she has always been very helpful when I am trying to teach options. She will patiently listen and ask questions, and it helps all of you learn. Well, Landry was just proposed to this past weekend, and it was such a happy event for our family. In fact, I went ahead and put the flowers out that were a part of her engagement party. So we are so excited for this development in our family. It's such a fun season in life when you see your child find the person she's going to spend the rest of her life with. So congratulations, Landry. I wanted to formally congratulate you and your soon-to-be husband. Very excited for the both of you. So what I want to talk about today with all of you is very important because this is how you can potentially save taxes. Now, let me start off by saying I am not a CPA. I don't even pretend to be a CPA, but this method has worked well for me. So I thought I would share it with you so that you can actually go speak with your CPA about it when you're doing your taxes or as you're preparing for your taxes. So one of the annoyances of making a lot of money in the stock market is you end up owing a lot of taxes, especially if it's selling options and it ends up being short-term capital gains. It's best if you can trade in a Roth IRA or even an IRA, and that helps avoid some of that tax hit. But if you need the money to live off of, which a lot of you watching my channel, you are trading for income, then it's in a cash account more than likely, and you will have to deal with taxes if you have gains. And I'm happy to say that a lot of my community members are enjoying big gains, but with big gains come big tax bills. So what can you do about it? Well, there's something called tax loss harvesting, and you can look it up. There has been a lot of videos made on the subject, and it's something that is done with institutions and, of course, with individual traders. But one thing that helps you with tax loss harvesting is if you have a position that you think will not be going very far, or you can wait to see if you can purchase it again, then you can look at going ahead and selling the asset for a loss. So all of the gains that you've had in the market that are taxable gains, your losses that are taken in that same year can usually be used to offset some of those gains. And so there's the rule about the $3,000 rule, and that's very confusing to people. But basically what that is saying is that you can only take $3,000 of your overall losses against any other income that you have. But when you're dealing with, let's say you have $100,000 in gains, but you are able to tax loss harvest and enjoy $50,000 of tax loss harvesting from pushing out some old positions that aren't going anywhere, then that reduces your taxable income to around $50,000, and that can save you considerably considering what tax bracket you may be in. So today, as I was going through my positions and trying to prepare for tax loss harvesting, I came across this little hack and I shared it with my community. They loved it, and I thought I would make a video on it to help reinforce what I taught them today, and then this will also help those of you that are interested in this kind of a trade hat. So as you know, I sell options. Well, one thing that I like to do is I like to do put credit spreads. Now, I have put credit spreads that are expiring in 2026. Well, if I have to wait till 2026 to get out of the position, it doesn't help me much because I am wanting losses for 2025. So if you have any positions that are credit spreads and they don't expire until 2026, go take a look at the position. Particularly, you want to look at the purchased put. Now, as you know, when you do a credit spread, it involves a sold put and a purchased put. But the part of the trade that makes you most vulnerable with a credit spread is the sold put. You want to ensure that you select a strike price that doesn't get anywhere near your sold put. That'll keep your trade safe. But the purchased put, you will notice as the sold put is gaining value, the purchased put is losing value. Now, that's just part of how the trade works. But I have figured out a way that I can use that lost value in the purchased put to actually do some tax loss harvesting for 2025. So in general, here's how it works. Before you take advantage of the put that has lost value, this is the purchased put that's lost value because the stock has gone up. Before you do that, you secure a new put that replaces that one that has lost value. And then after you have your new put to keep your trade a spread, Then you go ahead and sell for a loss in 2025 the 2026 put that has lost value. That gives you the active loss in 2025 against your active gains. You haven't messed up your spread. You still have a spread. Now you may have to widen it a little, but you would only do this if a few set of circumstances remain constant. One, you have to be really confident in the sold put strike price not being breached. So this will be a trade where you happen to select a really good strike price and it doesn't look like there's any chance of it getting to your strike price. That's the first criteria. The second criteria is it must be a trade that expires in 2026, because if it's a trade that expires in 2025, well, then it will just expire and your gain will offset the loss that you're trying to take. So this only works well if you would take a would-be loss for 2026 and you accelerate it as a loss for 2025 with half of the trade. So if all that was a little confusing to you, don't worry. I'm going to take you step by step so that you fully understand this trade hack that can help you save thousands with tax loss harvesting. All right, let me take you into the computer and explain what I taught my students today. I found the perfect trade to illustrate this with, so let me show it to you, and we're going to check the technicals to make sure our sold put is in a safe zone. Here's the trade. It expires in June of 2026. It's ticker symbol GEV, and my sold put is right here at 450. When I originally took out this trade, the sold put was $37.83, but now that GEV has moved away from my strike price, it's gaining value. So it's up right now, $13.98 in profit. You can see here now it's worth $23.85 if I were to buy it back. Well, because it has gained value, the purchased put right here, this $430 put, it was purchased for $32.23 as part of this trade. Now that GEV has moved up, it is losing value because when you purchase a put, you expect a stock to go down. So it's part of the spread, but if you treated these independently, this is how it works. So this is losing $1,213. It's now worth $20.10. When I initially bought it, it was worth $32.23. So if I just wanted to close down this trade, it would be in profit, and that's good. But here's what I want to do. You see this $1,213. If I wait till 2026 to shut this down, I won't be able to take advantage of tax loss harvesting. So what I want to do is I want to replace this 430 put with a new purchased put, ideally that's less expensive than $20.10. That way I make a little bit more money on the trade. And then I will go ahead and take this loss now. Taking this loss now will give me another $1,213 in losses against my 2025 gains. But before I do that, let's evaluate GEV on the technicals to make sure if I leave this sold put at 450, it's still a really good strike price for this spread. At the time of recording, GEV is trading just above $600. And so when I initially selected my strike price, I went well below the 200-day moving average. This provided a layer of support for me. Well, it still looks to be the case, and it still looks that this is a really good strike price because I'm well below the 200-day moving average, and we don't see signs of GEV starting to slip much further down. In fact, we are trading towards the top of the band, but look, our RSI is only 54. So there's still some room for that band to expand and for this to push up. So all things look good for my initial strike price below 500, and I'm going to stay with that for now, but I am going to see what I can do about replacing that purchased put. Now, if you're going to do this, it works really well on a green day for a few reasons. One, the green day is going to provide the maximum loss that I would be taking on the purchased put. But as I'm replacing that put with a new put, it is going to be less expensive because it's a green day. Let's go see what we can find. So like I said, my initial goal is to go ahead and replace this 430 put that I purchased. So I'm going to go a little bit lower. Now this will widen the spread. That's why I want to make sure that you're comfortable with your sold put. Now widening the spread a little on this end of the trade, it will require a little bit more money to secure the trade because you always have to have the amount of money between the sold put and the purchased put. Well, if I'm going lower in strike price on the purchased put, then that will widen my spread. So be aware of that and only do this trade if you do have confidence in your initial sold put level. Once you get to the option chain, you definitely want to go to the date that you have your initial trade. This is 6/18 of 2026. And here you can see the purchased put of 430 that I initially had, and then here's the sold put, and that one was at the 450 level. So because I'm going to be taking profit on this one, and it will be $20.40 that I will receive when I sell this, I want to repurchase one that is lower price. So let's look right down here at the 420. Now this says $21.90, but I ignore that because I am looking at my bid and ask. So the ask right now is $19.20. So the most that I would have to pay for this new trade would be $19.20. It should fill almost automatically if I put that in. Now, the way that you would want to consider engineering this is you have the sold put right here. You have the purchase put right here. This is the one that you're going to take profit on. But before I take profit on it, I don't want to leave this one uncovered, this 450 uncovered. So I would go ahead and buy a second put. That would leave me with two puts securing this one trade. Once that's taken care of, then I would go ahead and get out of this trade and take profit. Taking the loss now will allow me to enjoy tax loss harvesting that amount of money. But then my initial trade, this 450 right here, it's secured by the new put. So it leaves it a spread, and that protects my capital. Though, keep in mind, you are widening the spread. So going from 430 on the purchased put to 420, that's going to add another $1,000 in requirements to secure this trade. So it does leave you a little bit more vulnerable if the stock were to have something catastrophic happen. Now you've widened the spread, and that's the risk that now you have a trade with a larger risk. But if you feel pretty confident in your sold put like I do, then you can execute this and enjoy really the best of both worlds. It's trade hacks like this that has really helped my community grow in their knowledge of options. And once you fully understand options, your brain will start working that way too. You will start to think of unique ways that you can take advantage of gains and losses. So I hope you found this helpful. If you want to be a part of that community and find out these things real time and actually have me help you with those scenarios, please feel free to click the link below, and I would love to welcome you into the community. Remember, if you're with me, Trading with Ashley, there is no trader left behind. Now, just for fun, since we're honoring Landry, I'm going to leave a video that she appeared in, and it was very popular with all of you. I will leave that video for you right here.